Hi, Tahir. Thank you so much for coming to the Investor Talk. How's it going?
Hi, Massimiliano. It's good. We are in Cape Town, South Africa at the moment. Weather is changing, so it's starting to rain, but it's still quite warm, nice and humid.
You are one of the best places in the world, indeed.
Thank you.
So, today it's more talking about actually how investing in startups works, right? And especially on your side. But before we start, would you like to give an introduction to yourself?
Name is Thaheer Mullins, of course. I've been in finance and innovation for the last 9 years. Prior to that, I was working sort of with working for tech startups in one or two corporates. And then I guess the finance innovation, like that dedicated journey, started around about 2017. And went from incubation and advisory for early stage startups to grant fund management, and then from there into venture capital, and then progressed to being a partner in a venture capital firm, and then along the way started angel investing, and then sort of said, okay, how about we start angel investing more institutionally, and so set up the African Angels Guild alongside 5 other angels. And then we basically do deals now on a deal-by-deal basis where it makes sense, for anything that's literally tied to the continent of Africa. So whether it's an international business or it's headquartered outside or this diaspora, but they're doing an investment case or business case in South Africa, then we're interested.
That's very interesting. You have a broader perspective coming from the venture capital side and moving to the angel investing yourself, and after building actually an angel community, right, where you co-invest, all of you guys. Let me start. Many startup founders, they actually don't know how it works, right? When they raise funds, they don't have idea what is behind, or which are the decision-making processes when an investor must decide, assess a startup and going through. So can you explain what actually is the main difference between an angel investor, the process of an angel investor, so when you move in a more established environment where corporate venture capital goes?
Yeah. So it's quite interesting. So I just want to caveat my answer by saying, like, a lot of angels move from angel investing into venture capital, and I've kind of done the reverse. So for us, the way we look at businesses, we are quite structured, in that we've got a formal vehicle. We'll do it on an SPV basis. We do have an investment committee session. We do an investment memo, and we do meet the founders as well. The core differences, I would say, between what we're doing as angels versus how venture capital works is that we get to do these deals, off of our own balance sheets. So we are ultimately accountable. So what that means is that we have a greater deal of flexibility, in terms of what we look at and how we structure deals. So a venture capital fund investor will have a predetermined process as we have, but they've also got fund LPs that have come into it, that have influence how they structure that fund. So the lifespan of the investment, how much they can invest into a certain company at a time, and then also the different mechanisms that they invest in. So if we wanted to do a credit deal, we don't have to answer to anybody, and we can go do a credit deal. If we wanted to do a more sophisticated or a less sophisticated deal, we can do that. So we're pretty much open ended in terms of how we invest, but the venture capital fund manager, it's a very structured, very strict sort of mandate that they need to adhere to.
Yeah, they must report to the piece. They need to follow the guidelines. They need to return the money in a timing structure.
Yeah.
It's a different story. You're right. It's a totally different story. So you are more on the corporate venture capital, more on the, investing, as you said, out of the balance sheet allows you to be more patient, having more waiting capital for the right time to exit?
I would say less corporate venture capital, more sort of like business angel investing. And then,
Yeah.
for instance, like a deal that we're doing now, we used our network to bring in a family that's in the same industry. And we're still finalizing it, of course, but if it works out, that's actually institutional corporate capital, but it's coming in on the same terms as us. So, we don't have we stress to say that we don't have predetermined timelines to exits and those sorts of things. We just care about sort of the sustainability and the growth of the business so that we can eventually get to an exit. But, trying to predict that now is very difficult.
But many funds, many funds managers, they are moving from a close-ended to an open-ended fund, evergreen fund, because they understand that the time is not anymore 2-5, probably can be 5-10. And if you pre-exit, which means maybe you're losing 3-4 times return. Now, in your case, you are based in South Africa, so I presume you are mostly or entirely investing in African and South African companies. What's the profile of the fund that you're investing in?
Yeah, so it's quite interesting, right? I'll tell you about the profile, but like the companies that we've invested in, some of them are domiciled in the US, some of them are domiciled in French territories, others are domiciled in Middle East, but they have these business cases that they're developing on the continent. And so when we sort of, and also like the network itself is actually, so if you look at our core members in our network, and then there's obviously on a deal by deal basis, we'll go to the broader network, but the core sort of founding angels, it's South Africa, Zimbabwe, Paris, UAE, USA, right? So that's kind of like our spread. And then the profile that we look for, it's really a company that has already started generating revenue, but the valuation is still really early, right? So while we might, it's not really our MO to do follow-on investments. So we want to make sure that the valuation that we go in at in the beginning is valuable enough to us that it also allows us to account for future dilution. So like the companies, they're not too far advanced. They typically like 3 to 5 years old. Maybe the first year was setting up and getting a little bit of revenue, and then they started maybe growing. Sometimes we have actually invested in companies that were a year old as well. So the primary thing that we want to see is that these companies have a paying customer, because there's an entire journey that you go through even before you get to that paying customer, right? So you have fights with your co-founders, you have fights with your other funders, you have fights with your suppliers, your tech development partners, and there's a lot of pivots and things that happen before you even have a product, right? And then when you finally have the product and you go to market and somebody pays for it, they say, well, cool, I'll pay for it, but this is how much I'm going to pay for. And if you want me to pay more, this is what I need. That leads to that next pivot. And that's kind of the entry point that we want to come in, where you've got like a market-driven pivot, and you've now got data points on revenue that helps you shape and helps you shape how you think about what your business and product should look like. So that's kind of where we're coming in.
So you're very early, but not too early. They must already generate some kind of revenue and demonstrating the market validation and traction, right? But let's say a startup, being very, very, a very good one, a very compelling one, but still not generating revenue, having other kind of KPIs, but not revenue generating.
Yeah.
Is something that you consider, or revenue must be a must?
So let me put it this way. We went into it saying we're going to do these syndicated deals, or we're going to look at post-revenue based on prior experience. We were like, okay, cool, let's invest. This is the thesis. So we did one deal that was pre-revenue. And what ended up happening was they eventually got to market, but they took a lot longer than they expected to go to market. Once they hit market, like within 2 days, they were doubling volumes and those sorts of things. So it was really nice to see. But that delay in getting to market kind of like validated what our thesis was, which is like, get them when they have the customers, because that's the point of acceleration, and that's when we want to come in. So they haven't really done real institutional raises before. They maybe got a couple of angels behind them, but now they're sort of hitting that point where they're going to need to go talk to institutional investors. So we put them through a semi-institutional kind of process, and then we help get them ready to get more institutional investors on board.
I mean, there are very few, very, very few structured investors, venture capitalists. They really work in a pre-seed early stage. So, in case you invest, you like a startup, but the startup has already a couple VC in the cap table, are you considering working or probably decline?
Oh, well, no, we'll look at it. No, look, a VC is not a reason to not invest. Like I said, the reason we'll look at it is we'll say, what does that early valuation look like? What has the performance been to date?
That's the point for me. Normally, when VC working, valuation goes up.
So yes and no, right? So this is the cool thing about operating with the Africa kind of focus, is that valuations on the continent are typically way lower than what you would get in Europe and the States. So that's kind of like why we are able to come in a little bit early. Let me just think. We've come in alongside VCs. We haven't really come in after VCs just yet. So we've had some VCs that actually entered companies with us, sort of in the same round, but we haven't kind of followed a VC ticket yet.
Do you have any particular sector vertical that you're interested in?
No. So the whole point of us kind of starting the syndicate is sort of saying, we want to be agnostic. We want to follow the real opportunities, because remember, we're very specific in terms of what we're looking for that profile. And a lot of companies that raise funding, they end up going to VCs, right? Because they already have traction. The VCs like that. But then there are those founders who, for whatever reason, don't go to VCs, or they're quite hesitant. And so, we targeting that particular group. Now, if we go very specifically into a particular sector, there might be volumes, but the quality in terms of what we look for is going to filter out quite a number of opportunities. And so we're going to start losing opportunities, right? So we kind of kept it agnostic. And then the other part of it is we look at the deals that come through our desk and we say, okay, these are the core territories that the founding angels are in. So within those core territories, do we see scope for enhancing their business? And if they don't have a presence yet, can we then go and set up a subsidiary for that business for them? So that's kind of like the MO that we look for. So it's really a matter of being agnostic, and then whether we think with the skill sets that we have and the network access that we have, that we can actually help that business in some way.
But even though these startups, for example, are located in France, Spain, Europe, US, wherever, must they be African founders, or they can be any?
We're investing in a company now where it's domiciled in France. They don't actually have African born founders, but they've got huge traction on the continent. They've done a really good job.
Their business or links to Africa, so South Africa.
Yeah, not all, to Africa in general.
Okay.
South Africa is just one of their markets. So we're investing in that business. They're looking to hire, an African team, but for the time being, they don't have that yet. But we're happy because we like the traction, we like the team. We like that there is an Africa theme, like they're literally building this whole business around Africa. And, frankly, them being domiciled in France actually gives them access to a lot more support than they would otherwise have, because there's a whole French tech ecosystem that they're actually plugged into now. So we're also quite practical.
What about the ticket? I mean, what's the ticket size? And you co-lead, lead, or just follow the round?
Any and all. So we don't mind leading, but we are typically a small ticket. So we kind of look at the terms and we say, do they make sense for us? And then we'll either go or not go. So we don't like to dictate, because we know that we're a small sort of ticket. So our minimum ticket size, as an example, as a syndicate, is around 15K. So it's not a lot, but depends on the company. And what we see and the level of excitement, it goes up from there, right? So what we say is, unless we have at least a majority of the angels plus 15K as a minimum amongst whoever wants to put in from the founding angels, we don't do a deal, right? So once we have that, then we can start looking at, okay, cool, do we want to put in more? Do we want to raise? Do we want to? So there's a company that we looking at now, and we were putting in 30K as an example. And then a few more angels wanted to come in, and so like our amount was pushing close to 40K euros. And then we mobilized a family business, and if they come through, that's 500,000 euros that comes in, so it's literally a big range that just depends on the synergies of what we have in the network, and then like the strength of the company and the level of excitement that we have.
So you help them to find other investors as well?
Oh, for sure. Yeah. So our view is that if we help them win, we win, like,
of course.
And then like when we also, a lot of these syndicates, they'll say, if you want to participate in the deal, you got to pay a fee, so we don't actually do that. It's like, hey, come and join the deal. There's upside for everybody, so we just want to make sure we get the deal done and we can succeed.
That's a win-win approach.
Yeah.
I mean, aside networking, outside giving access to a network of investors, how do you help them? Do you have any hands-on approach? I mean, if they need some mentoring, some advisory, do you do this kind of support?
So definitely around advisory and mentoring. So they got to want it from us, and we happily give it to them. But sort of like, because we're small investors, we don't really see ourselves as operators in the businesses. So we'll do a lot of support work. We can help set up client meetings opportunistically. If they're going through fundraisers, structuring, governance challenges, we can help them with that. If it's fundraising support, we can help them with that. So we do get involved if they want us to. Like from some of the deals, like we're some of the smallest investors, but and they're much larger investors on the same cap table, but they come to us and they're like, look, this is the situation we're in. How do I explain this narrative to A, the other larger investors, and then B, to the new investors that want to come in? And then we'll advise them, so, and we're happy to do that.
I mean, I believe advising, mentoring startups in a very early stage can be very beneficial for both sides. I mean, for you, securing that the investment goes right, it pays back in good multiples. At the same time, for them to move forward, to not fail and actually succeed. In terms of supporting startup and mentoring, we've been covering enough. Now, you're a professional investor. You've been investing for a while in different sectors. Where do you see the leverage, if any, that funders working, not just coming from Africa, but working in Africa can have? Is the African market good enough and mature enough already?
So it really depends on the industry. And then I guess the founders and the ability to execute in multiple markets. So it's not easy to do multiple markets on the continent because there's a lot of fragmentation. The laws are quite different. We have some sort of regional blocks, but even within the regional blocks, it doesn't sort of cover wholeheartedly sort of, like the EU. You do have individual companies, but there's a lot of synergies that union actually brings. So, if I enter into Spain, there's a good chance that I can get into Germany, into like all these other countries, but it's not necessarily the same on the continent. So what we like to see is them being able to demonstrate to us how they can access multiple markets, that they already have that ability, but then also how they could potentially grow beyond Africa and into the likes of a GCC or into the likes of an EU or even the US just on its own. Like having an individual focus in an individual territory on the continent is very challenging because the markets are small typically, and then there's a lot of sort of inequality in the markets, right? With your base level being really low, and then your ceiling being really high. But because there's so much inequality, like generally the market opportunity for high margin opportunities is a little bit small. So you need to be able to get into multiple markets. So if you can demonstrate multiple markets on the continent, it's fantastic. Even better if you can demonstrate on the continent plus another block somewhere, another market somewhere. That's very attractive to us.
I mean, as you say, moving to different multiple market is pretty challenging. It's not an easy way to go. I mean, better is from one to another. Outside market traction, which means revenue in this case, what you see, what to evaluate when investing in early stage startups?
Yeah, it's always a bit of a gamble, right? So you can look at IP, you can look at market potential, you can look at who is advising them, you can look at all those things, right? But none of that is a sure predictor at that super early stage for success. So we check out all those things just to make sure that the numbers make sense and that if they execute well, they can potentially achieve those things. So we look at that, but by far what gives us the most confidence to do a deal is the actual founding team at that stage. Like who they are, do we think we can work with them? What are their individual and collective accolades that has gotten them to this point that we think will help drive them going forward? So those I think it's mostly around the thing that really will make us say yes or no in the end is around the founding team themselves. So we need to know that you know the industry, that you're good at tech, and that you can sell. Like if we don't see those three things, then I don't know if we're going to do the deal.
Wait, do you invest in solo founders or you need a team to be realist?
Prefer teams, have done solo founders, but mostly we prefer teams. We probably won't do many more solo founder deals because the risk is a little bit high. Because like I said, we want to see tech de-risking, we want to see commercial de-risking, we want to see knowledge of the industry. And it's very infrequently that you'll find a solo founder that can do all three. Sometimes, if they're fortunate enough, you do have a solo founder that's able to build a team around them that complements that, But the only way we're going to do a deal into a business like that then is if there's been an employee share option scheme. Maybe some of those team members are going to get some equity down the line or a portion of the transaction when you exit. Like those are the kinds of things that we would need to see to believe that you are going to be surrounded with the right skills going into the future.
But do you see similar pattern or scales when investing in successful startups? Because there are some similarities. Founders have some kind of similarities in successful startups.
Yeah, so the patterns that we see is second time founder, even if the first one failed. They usually, like that second time around, they come hard and they do it really well. Second time founders, even better if they've got like an exit under their belt. That ability to get early traction where they shouldn't have. So one deal that we did as an example, they had an absolutely new product, and it required some capex investment to get off the ground, and they went and they funded that themselves, right? Then they went to a commercial bank and they managed to they went to a Ferrari track day event, and then they managed to speak to the head of commercial. We then went to the board. We then created a special product just for them. You know, like that's a level of hustle and value unlocking that you don't typically see, right? So again, so we look for those kinds of signs as well. And then, having like that synergy between at least two founders, where one says, this is my core skill, I'm definitely good at this. Another one says, and this is my other core skill, which is the backbone, and I'm really good at this. Like that. Those are the, if you have a combination of all of those, like you'll.
I noticed, startup invested in mentoring, advising. Many founders, they're very skilled in technology, and after we moved there, but they have a very little skill in management, not because this first time founder, maybe they don't have a management school behind. Do you evaluate those guys in a way that, okay, now it's early stage, you don't need to be so much skilled in cash flow, finance, any kind of, okay, structuring a very profound flow inside your company, but after you need to go there. So do you evaluate that those guys have some managerial skills, or maybe can be acquired?
We like to see it because it's early, and they don't have to have everything. So we've got portfolio companies where they've, for instance, got an outsourced CFO. So they don't have a CFO in place. They got people doing their secretarial and bookkeeping. They would have an outsourced hardware development firm or an outsourced software development firm, but they have the ability to manage those relationships to the benefit of the company. So we do like to see a level of managerial skills. It doesn't have to be that you went to business school. We just need to have a sense that you do have that. Like you can engage with the founder about their journey. Literally, last week Monday, I was at another event, and we had to select who was actually going to get funding, and where everybody else was asking about company traction, this, that, and the other. I was like, okay, how did you get into this business? Okay, how did you exit? Whose idea was it to exit the previous business? What happened to this partner? Why did they leave? Have you fired anybody yet? Why did you fire them? How long were in the business before you fired them? So you kind of like get a sense, and through that line of question, you can be like, okay, this is a really strong managerial or executive skill set that's in the business. And then from there, you can say, well, I've got enough hints to say with reasonable belief that I think that they'll be able to manage the business well on A, B, and C fronts.
I mean, you mentioned exit. So how important is for you those founders have a clear exit strategy?
A clear exit strategy versus an idea of an exit strategy is kind of like, it's very hard to have a clear exit strategy from day one, because so much is going to happen in that 5 to 10 year journey, maybe even longer, for you to get to that exit. Your strategy, your product, your tech, everything might pivot. And the minute you do a pivot, somebody else then becomes your viable opportunity, right? But to have an idea is important because it shows us your thinking, your level of forward thinking as well. And then it also gives us an idea of the kind of relationships that we could help build towards to help you get there. So your strategy and everything might change, So clarity on that exit, I don't think we need to have that, but an idea of what you're building towards and when you want to exit, so we can align on all of that. That's important.
I mean, I have my point of view on this, which means as a founder, you start your own company, okay? And if you start your own company, the aim, of course, the aim is in the tech ecosystem, solving problems and find solutions. But at the same time, I mean, you want to build a company, okay? You want to make this company as big as possible. So your focus must be there.
Yeah.
Now, if you're building something great, acquire will come. You don't need to go there.
Yes.
If you go there, you're not building something great.
Yeah.
This is my point of view. So, for example, when I did EquityMatch, and we raised half 1 million roughly in USD, and the cap table is probably 100% my friends. And when they told me, Max, do we have an exit strategy? I said, absolutely not. No, I don't know. I mean, we built, we try to get this company at least 100 million valuation. And if we get there, somehow maybe will come. I don't know. I never thought about exit strategy. I'm not even going to think about exit strategy. But some of them ask, right? Some investors, indeed, they ask you when I should exit, when I can exit, especially angel investors. Can I exit in 2 or 3 years' time? Where you will be in 2 or 3 years' time? How much I do get. But anyway, so we are full wherever you are placed in the globe in AI. And the landscape changed dramatically. Investors are, they're investing so much in AI, whatever is related to AI. But at the same time, AI very much is disrupting everything. You can indeed create an application, not a full function application because we are still not there, but you can create a nice application probably in 2 days, validating your idea. So do you evaluate the disruption of AI when you invest? Which means if I invest in those guys, can they be replaced in a week or 2 weeks by any AI agent, wherever it is?
Yeah. No, it's definitely, we look at that all the time. So the lens that we have is, A, can you be disrupted by AI? And what's that potentially going to look like? And then it's also B, sort of how are you using or feeding into AI, right? So if we do this deal, have you already started using AI and maybe not to its fullest potential, which helps you maximize more value? But then also, like the one deal that we're doing, it's quite interesting in that they benefit from the increased use of AI because of their product offering and the solution, right? So we look at that and we're saying, okay, cool. Where is the market going? Like what are the regulatory changes happening there? That's either going to hamper or increase your ability to make money off of the AI bonanza. But in terms of like individual companies, for sure, I mean, would we invest in a design company now? Like that's going to be really tough because there's so many, like AI has helped commodify like the design business. So you coming in as a skilled designer now is like really difficult, so you're building a business as an example around that. It's really tough. So we do look at that. We're obviously looking like, is the business going to be around in 5 to 10 years? And like depending on where the trends are going, are we still going to be able to sell it at a high valuation in the context of all these changes? So there's some businesses that might actually survive being replaced by AI, but the value of those businesses are going to be significantly diminished over time. And it's hard to predict all of this into the future, right? But we try and see, we do what we can.
Do you have any fixed number when it comes to multiples in exit? So for example, You've been working venture capital. Venture capital, they must replace at least all the capital deployed plus probably
Yeah,
5 times return, 10 times return. So
yeah,
if my fund is 10 million and my target is 10 times return, I must
yeah.
invest in any startup giving me back 10 million plus 100 million, 110. Now, in your case, do you have any multiple? 5 times, 10 times, 2 times?
Yeah, I'll tell you, we love 100x, we love 10x, but the reality is we don't have a very specific multiple as angel investors. I mean, individually we might have those, but as a syndicate, we don't have a specific multiple and we don't have a specific time horizon. So we just look at the quality of the business and the quality of the founders, right? So to give you an example, got an exit after 2.5 years of 3x, and that was a company buyback. We looked at it. Yeah, we looked at it and we said, well, you know what? Let's just take the liquidity. It's cool. Everybody in the deal was comfortable. We had a vote. Majority said yes, and so we did. So that's kind of like how we approach it. We probably won't take an exit for under 2x unless it's a poor, or under 3x, sorry, unless it's a poorly performing company and this is our chance to get out. But generally, we are quite flexible. The view generally also is that after 3 years, the multiple needs to be higher than 3x. So we start looking at that as well. But having a fixed sort of, I'm coming in and I'm leaving at 5, 10, 15, 20, 100, we don't actually have that.
I understand. In terms of, so we covered this sector, and you told me that you're pretty flexible in investing in startups. But there is, in your opinion, any sector for the next 24 months? Because going to 5 years, it's absolutely impossible now. But maybe 12 months we can talk, 6, 12 months. Disruption of technology just too fast. Do you see any sector where you actually you are thinking to invest because you see the flow of the money moving there, and where the money goes, the valuation is higher and the exit is probably higher?
Yeah, we don't actually do that. We try to avoid the hype sectors. Like we wouldn't invest into an AI specific like company right now, just because everybody's doing it and because there's too much activity, and because there's so much activity, it's really hard for you to like convince the founders that the valuation is unreasonable, and then B, trying to get other investors to come in at a lower sort of price tag. The reason the investors don't want to, I know it sounds counterintuitive, but the reason they don't want to is because when in cycles of hype, they want to just do deals and get them done and be a part of sort of that trajectory. So there's a lot of competition, and so the price keeps going up and up and up. And so we try to avoid those. We're small angel investor network, and we're not trying to play that game, at least for now. So that's pretty much somebody else's game. So we do try to look at kind of like underserved opportunities where everybody is looking left, which gives you a better valuation when you look right. And then sort of saying, well, where is that going to be? How is that particular sector opportunity positioned for the future when there's no longer an AI hype? So that's kind of the cycles that we do.
Funders, many of them, the majority probably, they very struggle to get in touch with angel investors. So how funders reach you? How do they find you?
Primarily LinkedIn. And I think with a lot of angel investors, it's by design that it's not that easy to find them because you're not typically doing high volumes, so you'll find, and I've had numerous conversations with lots of networks across the continent and also abroad. It's only when you reach a level of volume in terms of the number of angel investors that you have. I'm talking about hundreds and thousands in terms of what you have in your network. Not hundreds of thousands, hundreds and thousands. Then it sort of becomes, it makes more sense for you to be a little bit more publicly accessible because you're doing higher volumes, right? Because you've got a lot of different people and you've got a business model tied to that that's not based purely on exits. So you might have a subscription, you might have a deal by deal ticket or allocation that comes through to the network. When you're in that context, then sure, find me on the website. This is the URL. This is where you submit your forms. This is where you do whatever. For now, it's primarily been through network, word of mouth, other founders, people on LinkedIn, some dedicated events. That's how we've actually found our pipeline.
I mean, I'm sure from today they will be able to see you also on EquityMatch. You are here, and I'm confident you will join our platform so they can come to network with you as well in EquityMatch. Let me let me close because we are close to the end. But let me close with any suggestion that you can give to any funder, not only based in Africa, but wherever in the world, how they should approach investors and how they should pitch the idea.
So I think the first thing is just have a pitch deck. It's like having a driver's license. So I had somebody approach me at an event. I was speaking on Saturday, and they had a very interesting story. I was like, okay, cool, just send me a deck and we can have a discussion. And the response is like, I'm still working on the deck. It's like, okay, cool. If you don't have a driver's license, you shouldn't be on the road. That's kind of the that's kind of the thing. So like, make sure that you have a deck.
Nice.
Then the other part of it is understand or try to understand the investors that you're talking to and where you are as a business in terms of the type of investor that you might need, right? So venture capital is good for a lot of businesses, but it's not necessarily what every business needs. And it's the same for angel investors. So just maybe research the investors that you're talking to try and ascertain if A, they are the type of investor that you want, and then B, if they are the category of investor. So the type of investor being maybe they're hands-on, maybe they're not, maybe they have a market access program, etc., etc. And then categories like, is it an angel? Is it a VC? Is it a foundation or development finance institution? All of those, or bank, all of those have different value offerings that you need to understand before you actually approach them. And for some of them, it's starting a journey that you can't just stop, right? So for instance, you get an angel investor, like you get us, our expectation is value and an exit at some point, not an exit by this day at this minimum multiple. You get a venture capital investor, they want to see a validated proof of the company being at a higher valuation that they went in, and that means getting a new investment round every 12 to 18 months, and doing a fundraise is a lot of pressure and a lot of stress. And, some companies do really well with that. Others don't. So you need to know, whether you're ready for that journey or not. Because once you get your first VC investor, you got to find a way to either buy them out or get somebody else to buy them out or exit the business.
Indeed.
So you can't just hop off that train. You're going to the final destination. So
absolutely right. And any founder should do their own due diligence on investors as any investors does with them. Because if you get the wrong investor in your cap table, you can really die.
Yeah,
that's the point.
Yeah, I mean, I've been on cap tables where investors fight with each other in front of founders. And it's not great. So pick wisely.
They indeed must be aligned. Thaheer, thank you so much for coming to the Investor Talk. It's been an absolute pleasure for me. Anyway, we met in person, and I hope we can meet again, maybe the next Tech Off Istanbul.
Yes, Massimiliano, thank you very much. It's been lovely to engage. Thank you for the opportunity. And I look forward to seeing this online and hopefully joining the platform as well.